Are reverse mortgages risky? Well, in order to figure that out, we have to compare it to the other options that you have as a homeowner to withdraw the equity from your home. There's really 4 different ways you can withdraw money from your home. You can sell the home completely, sell it outright. You can get a new forward or conventional mortgage. You can also get a HELOC, a home equity line of credit, or you could do a reverse mortgage. So let's compare a reverse mortgage with those other options and see what one is more risky. First of all, selling your home. The downside with that is you probably want to stay in your home if you're looking to withdraw equity from it. But beside the point, if you did sell it, it's pretty expensive. You're looking at 7 or 8% just in costs, let alone the cost of actually moving and then finding a new place. And then fixing that up to where it fits your needs. A lot of expenses. So that's the downside with that. And riskiness, maybe you're buying at the top of the market. You might be selling your home at the top of the market, but you might be buying at the top of the market. And if property goes down, you've got all that money invested in the new place and it goes down compared to if it stayed in your old home and the property value went down, well, you bought it way down here, maybe at $100,000 15, 20, 30 years ago. And now it's worth 400 or 500 or 600,000. So if it drops back down to 400, you're still ahead from what you actually paid to begin with. The other option is a regular refinance. You go get a new loan and a new 15, 30-year loan, you get cash out. Odds are your payments are increasing because you're getting a bigger loan now. And also you're extending out that payment. Odds are, most of the time, not every time, but a lot of times you extend that payment out 20 years or 30 years down the road, you're going to have a payment probably for the rest of your life if you're over 60. If you do a 30-year mortgage, you're going to be paying on that loan for the rest of your life. Odds are. And that might not be the best alternative for you. The other thing is you're responsible to pay that payment. What happens if you don't? That's right. You get foreclosed on. With a reverse mortgage, there's no payment required. You can't get foreclosed on as long as you pay your property taxes and insurance. Those you do have to pay, just like if you owned your home free and clear. You do have to maintain the home. You have to live there as your primary residence and keep your name on title. Those are the requirements for the reverse mortgage. As long as you do those 5 things, you can never, ever, ever be kicked out of the house. You can't outlive the loan, nothing, okay? And you can make payments on a reverse mortgage if you choose to, but it's not required. You can also get a HELOC. Now, HELOC is a second mortgage on your home, a home equity line of credit with your bank. You go get a new line of credit for $50,000 or $100,000. Guess what that's going to come with? That's right, a payment. You have to pay interest only, but it's still a payment. If you don't make that payment, you could be foreclosed on. Again, with a reverse mortgage, you don't have that payment. The other downside with a HELOC loan is that it's only typically good for 10 years. So you've got 10 years that you can use that line of credit. Then you have to requalify. If you take out that loan when you're, say, 62 or 63 years old, and now you're 72 or 73 and you have to requalify based on your new retirement income, which is probably lower than what it was when you were earning money from a job, you may not be able to qualify to renew that loan. And what happens then is you lose the line of credit and they take your loan balance and they recalculate it to a principal and interest mortgage payment. So your payment's going to go up in the worst time when you can't really afford it because you're retired and living on a fixed income. The other thing is too, is that they can reduce that line of credit just like that. It's up to them. They can do it at will, really. If you had a bad credit situation on another loan completely and they found out about it, they could say, you're no longer a good risk for us and we're going to limit our losses and we're going to cut that line of credit. Or if the property value were to drop, now the underlying asset that secures that second mortgage is no longer worth what they thought it was going to be worth, and they could reduce your line of credit or eliminate it too. Neither of those can happen with a reverse mortgage. It's guaranteed. And then the other thing with both the HELOC and a forward mortgage, if the loan balances are ever larger than the value of your home, so you're upside down, let's say property values drop by 30% again, like in 2008. If that happens, they can, and you they foreclose on you. You can't make the payments and you have to leave the home. They foreclose on you. They sell the house for whatever they can get for it. The lender does. And then they'll come after you for the remaining balance. It's called a deficiency balance. They could sue you in court and get a deficiency judgment against you. And they can come after you for that extra $20,000, $30,000, $40,000, $50,000 that they lost. And if they don't come after you and they write it off, they just count it as a loss, they're going to send you at the end of the year, they'll send you a 1098. Basically, that'll be like $30,000, $40,000, $50,000 worth of income that you earned, they're going to say, and now you have to pay taxes on it. Now, I'm not a tax advisor, I'm not a financial advisor, but I've heard those stories, and it's not a pleasant thing for people to undergo. Now, with a reverse mortgage, then, like I said, there's no payment other than your property taxes and homeowners insurance, maintenance on the home, living there as your primary residence, and keeping your name on title. As long as you do those things, the line of credit can never be closed. The property value could drop by 50, 60, 70%, and you could have more available in your line of credit than the house is actually even worth, and they still can't drop that line of credit. They can never come after you with a deficiency balance either, because there's mortgage insurance, and in that situation, the mortgage insurance pays the lender, so the lender's not going to lose any money. They're not going to come after you, your estate, or your heirs for any potential losses. Which is more risky? We've gone over a number of different things. In my mind, reverse mortgages are not risky at all. They're something you should really take a closer look at, in my mind. My name is Bruce Simmons. I'm the reverse mortgage manager for American Liberty Mortgage here in Denver. I'd love to talk with you about your specific situation. Feel free to call me at 303-467-7821 or visit me online at reversemortgageradio.net. Thanks so much.